Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finances. And today we are diving into a quarterly report from C.V.B. Financial Corp. Get ready because this report has some interesting shifts that tell a story about their strategy and the economy. Before we dig in, if you get value from these deep dives into company filings, make sure you are subscribed and hit that notification bell so you never miss an update. We also have a Discord community where we discuss these filings in real time, linked in the description below, so come on over and join the conversation. Alright, let's get into it. This is a quarterly report, a 10Q filing for the period ending the 30th of September 2025. Think of this as a mid-year check-in, giving us a snapshot of how the company is doing financially. First up, the balance sheet. This is like a snapshot of everything the company owns and owes at a specific point in time. As of the 30th of September 2025, their total assets were a whopping $15.67 billion. That is a decent chunk of change, and it is up from $15.15 billion at the end of 2024. Where is all that money going though? Well, a big chunk of their assets, over $4.8 billion, is in investments split between available for sale securities and those held to maturity. Now, these investments have a fair value of $2.58 billion, but here is a kicker. They had a pretty significant unrealized loss on these, a pre-tax net unrealized loss of $333.8 million. Now, unrealized just means they haven't sold them yet. If interest rates go up, the value of these investments can go down, and that is what happened here. It is a big number, and it shows how sensitive their investment portfolio is to market swings. Now let's talk about loans, the bread and butter of a bank like C.V.B. Financial. They had about $8.47 billion in loans and lease finance receivables. Now that is actually down a little bit from the end of 2024, but here is what is really interesting. The biggest chunk of their loans, nearly $6.54 billion, is in commercial real estate. That is a huge concentration, and in today's environment, that is worth paying attention to. Moving on to income, their net interest income, which is the difference between what they earn on loans and investments and what they pay on deposits, was about $115.6 million for the quarter. That is up a bit from the previous quarter and also up from last year. But their non-interest income, things like fees from services, was around $13 million. This is kind of a mixed bag. It is down from the previous quarter, mainly because they had a loss on selling some investments, but that was partially offset by a big legal settlement. On the expense side, non-interest expense was about $58.6 million. This includes salaries, rent for their many branches, and other operating costs. Interestingly, this expense is actually down a little bit from last year, which is good to see as they try to be more efficient. Looking at cash flow, which shows you where the money is coming from and going to over a period, they generated about $176.5 million from operations in the first 9 months of 2025. Investing activities, which includes buying and selling securities and loans, added a pretty good chunk of cash too, about $168 million. Financing activities, which involves managing their debt and equity, also provided cash. Overall, their cash and cash equivalents at the end of the period were over $783 million, a significant increase from the start of the year. That is a lot of cash on hand. Now, for any bank, managing credit risk is super important. This is about making sure they have enough money set aside to cover potential loan losses. Their allowance for credit losses was about $79.3 million at the 30th of September 2025. This is actually down a bit from the end of 2024. They had a small recapture of credit losses, meaning they took back some money from their expense because fewer loans defaulted than expected. The big worry though is that heavy concentration in commercial real estate. If that market tightens up, their loan portfolio could face more pressure. Let's talk about how they value things. The fair value hierarchy helps us understand how precise those values are. Most of their investments are in level 2 inputs, meaning they are valued based on observable market data. That is generally a good sign of transparency. The fact that their level 3 assets, the ones valued using unobservable inputs, are pretty much zero is also a positive for how they report fair value. Now, this is where it gets a little spicy. They use derivatives, specifically interest rate swaps, but they do not treat most of them as official hedges for accounting purposes. This means that changes in the value of these swaps can directly impact their reported earnings. They do this to manage interest rate risk on loans with customers, essentially converting variable rate loans to fixed rate for the customer while they manage the risk themselves. They have a significant number of these, over 100, with a notional amount of over $347 million. While they say the changes in value mostly offset each other, this is an area that could introduce volatility to their earnings if something unexpected happens with the customer or their counterparty. Looking at their loan modifications, they've modified over $10 million worth of loans to borrowers facing financial trouble. The main issue here is term extensions, pushing out repayment dates. While this can help borrowers, it also means the bank's money is tied up longer. and it can sometimes be a sign of underlying weakness in the borrower's financial health. And when we talk about non-performing loans, those are loans that are not generating interest income because the borrower is not paying. At the 30th of September 2025, they had about $27.8 million in non-performing loans. That's about 0.33% of their total loans, which is actually pretty low. That is good news. Oreo. Other real estate owned, which are properties the bank took back after a foreclosure, also decreased significantly, which means they are selling off those assets. Let's look at their obligations, their debts that they absolutely have to pay. They have over $12 billion in deposits, and most of that isn't earning any interest for the customer. That is awesome for the bank. Their borrowings, including FHLB advances, are around $951 million. They also have future operating lease obligations and equity investments that add up. And then there are the commitments to lend money, over $2 billion of those. Most of that is in commercial real estate and commercial and industrial loans. These are like pre-approved loans. While not all of them will be used, it shows there is demand, but also potential future loan exposure. So what is the story here? C.V.B. Financial Corp is navigating a complex economic environment. On one hand, they are managing their expenses well, and their core net interest income is holding steady, even improving slightly year over year. They've got a lot of cash on hand, which is always a good thing in uncertain times. Their deposit base, especially the non-interest bearing accounts, is a significant strength, providing a stable and cheap source of funding. However, there are a few things to keep an eye on. That heavy concentration in commercial real estate loans is a big one. If the CRE market continues to face headwinds, it could put pressure on their loan portfolio. Also, their use of derivatives that aren't formally accounted for as hedges introduces a bit of earnings volatility that investors should be aware of. They are also seeing a decrease in their loan portfolio, which could be a sign of slower lending activity or a deliberate strategy to reduce risk. The slight increase in unrealized losses on their investment securities is also a common theme in the banking sector right now due to rising interest rates. Overall, C.V.B. Financial seems to be managing its way through the current economic landscape with a focus on controlling costs and maintaining a strong deposit base. Their strategic shifts, like using derivatives for loan management and managing their investment portfolio, are key to watch. The commercial real estate exposure remains the most significant risk factor to monitor closely. Alright, that concludes our deep dive into C.V.B. Financial Corp. What are your thoughts on their strategy and these financial numbers? Do their commercial real estate holdings concern you? Let me know in the comments below. If you found this analysis helpful, please smash that like button, subscribe for more in-depth corporate breakdowns, and don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for tuning in, and we'll see you in the next one.